Okay, this video is going to show why we do what we do to prepare a cash flow statement with the indirect method. The indirect method only affects the operating section of the cash flow statement, and it has us back into our cash flows from operating activities starting with net income. So I'm going to use this sheet to explain why we do what we do and why it works. Alright, so the steps to do the operating activities section starts with net income. And here's my income statement. So net income is $15,000, but notice that it has mostly operations in it, but a few items that weren't cash, and also at least one item that doesn't have to do with the daily operations of my company. So we're going to adjust for those items. So here's my steps. First, I'm going to start with net income, which I did right here. Next, I'm going to add back depreciation. Let's talk about why. Depreciation expense is an expense, and it made my net income go down. However, it didn't have anything to do with cash. If you look at my journal entry that would have been made, you debit depreciation expense and credit accumulated depreciation each time you have an adjustment for depreciation, and there is no cash coming out. So we need to add back in that. So that's what I've done right here. I've added back my depreciation expense. It was easy for us to see depreciation expense because we have an income statement. If you would have just been given your balance sheet, you would be able to look at your change in accumulated depreciation and see that it went up from 60 to 61, so that was my depreciation. However, beware that if you had also sold a depreciable asset, you would need to take into account that before assuming that all of this was current period depreciation expense. That's beyond the scope of this lecture, but I just wanted to put in that warning. Okay. Step 2 says to remove gains and losses. Let's talk about why. In this net income number, we have a subtraction for a loss on sale of investment. But an investment is a long-term asset and it doesn't belong in our operations. We just need to remove that. Plus, it had nothing to do with the cash of it because look at the journal entry that it could have come from. We got cash for those investments of $54,000, but they had a book value of $60,000. That means that we had a book loss of $6,000. This is the amount that we're removing from our income statement because there again it didn't have to do with cash, and also it belongs under the investing section. So I'm going to remove the effect by adding it back. If it was a gain, I would remove the effect by subtracting it. I'm just doing the opposite of what it did to net income. Alright, the next one says adjust for changes in current assets. So if you look at your accounting equation, it says assets equal liabilities plus owner's equity or stockholders' equity. We could look at that as net changes in assets equals net changes in liabilities plus net changes in equity. Let's further break that down, and if I just want to know about my change in cash, which is all that I want to know about, I could say my net change in cash is equal to, and I would say my net change in liabilities plus my change in my equity. And then if I needed to get all my other assets onto the other side of the equal sign, I would say minus, to get it on the other side, non-cash assets. Alright, so in looking at that, then you would see that non-cash assets has an inverse relationship. So when I start telling you that it's going to do the opposite, you'll remember this theoretically why. But I'm going to give you a couple other reasons why, because it just works mathematically no matter which way you look at it. Here we go. Ordinarily, you would not be able to see which of your sales were cash and credit sales. However, for this purpose, for illustrating this, I have broken it down. Let's say that I had sales on account that I have not yet received the money for of $25,000. I have accrued sales of $25,000. That means that I've earned them, but I have not received the cash. Look, those sales went towards my net income. They added to my net income. But I haven't gotten the cash yet. So I need to reduce my net income by that amount. So I'm going to take out $25,000 of those sales that I haven't received. But remember I told you normally we don't have this breakdown? Normally, we would have to look over here at our change in current assets, and from 2016 to 2017 it went up. When current assets increase, we need to decrease them. And that's what I mean when I say it has an inverse relationship. The change in the non-cash assets of accounts receivable in this situation has an inverse relationship to our reconciliation. So we are going to say it went up, we go down. And again, that just makes sense because these are credit sales that we haven't gotten the money for, and they show up over here in the change in the balance sheet account. Okay, liabilities have a positive account over here, and so when they go up, we go up. When they go down, we go down. Let's look and see why this works. Let's say that all of these, the utility expense, we did already pay for. But let's say this salary expense was actually an accrued expense. Remember when we learned in chapter 3 or so that our employees have worked Monday, Tuesday, Wednesday, but we don't plan on paying them until Friday. So on Wednesday at the close of the year, we accrue salaries. Accrue salaries means that we go ahead and recognize the expense, and we set up a liability for that. So even though my salary expense reduced my net income, I haven't paid it yet. So to get this to a cash basis, I need to add it back. Okay? And again, normally you couldn't see that on the income statement. So instead you would look at your salary payable account, and let's see that it went from $10,000 up to $25,000. So in other words, I'm holding on to some cash that I haven't paid out yet. It went up, I add back. And I would do that to every single current asset except cash. And I would do that to every single current liability except dividends payable will be used in the financing section, and I'll explain that in a separate video. Now I do want to explain why it also works if my change is different. So let me show you. If accounts receivable, instead of having gone up, actually went down, because current assets work the opposite. If it went down, I would have increased it over here. It would have said decrease in accounts receivable, and I would have increased my number. Here's why. I had extra cash coming in from a prior period that wasn't showing up in my sales because it was from a different period. So, but it did affect my cash in a positive way. So accounts receivable going down makes my reconciliation and net income increase. Let's talk about if salaries payable would have gone a different direction. Here it went up, and when the liability goes up, we go up. But had it gone down, that means I would have paid out more than what I'm showing as my expense in here, because I'm paying out from a previous period. So if it went down, I would need to reduce this because more cash went out than what I showed inside my net income for the period. So that's why it works both directions. And remember, this is only for current assets except cash and current liabilities except dividends payable.